I hope the microphone is on. It seems to be. Those sensible people who were here in the last session will know who I am, but if you're not, I'm Martin Wolf from the Financial Times, the indispensable organ of the global crisis. We are going to discuss the global economic outlook in 1 hour, and I've got a very distinguished panel whom I will introduce first. The way we will proceed with this is we'll have an opening discussion which will last perhaps 20 minutes, perhaps follow-up points that arise, but I really do want, people always say this, I really do want questions from the floor, so I will try and make that 20 or 25 minutes. When we do get to the questions, please make them questions, not long speeches. I'll cut you off, and I hate being rude, particularly in China. It's not a nice thing to do, but I will be. So please ask questions, and we'll have a good discussion. Now, to introduce our speakers to you, to my immediate left is Mr. Sheard, who is Director General of the Financial Research Institute of the Development Research Center of the State Council, and is therefore an extremely important man. And I'm looking forward very much to what he has to say about the Chinese economy. To his left is Paul Sheard, who's Global Chief Economist and Head of Economic Research at the Nomura Securities International. It says here in the US. Are you based in the US? I hadn't realized that. I assumed you were based in Tokyo. To his left is Mr. Ma Jiantang, who is Commissioner of the National Bureau of Statistics of China. A very, very important man for obvious reasons, since we follow the Chinese statistics probably more closely than any other statistics in the world. To the left is Gerard Lyons, also British, a man I've known for a very long time and respect enormously, who's Chief Economist and Head of Global Research at Standard Chartered Bank. I think people will know what that is. And finally, another old friend, I shouldn't say a friend of some standing, we won't discuss the old, Mr. Nariman Behravesh, who's Chief Economist at IHS in the USA. So we've got a nice broad panel, but with a strong focus on China, as we should. In introducing this theme, this discussion, I thought instead of going through the regions, which we'll do in the discussion, I just sort of lay out what I think of as 4 themes for our thinking about the world economy. Very, very briefly. The first, which was already raised in the previous session, is uncertainty. It's been a theme of the pronouncements, for example, of Ben Bernanke about his view of the economy. It's clearly something that business people in the West are talking about all the time. And I think it's a pretty genuine and understandable sense of the state of affairs after what was, after all, a huge financial crisis. So the first theme is uncertainty, and I always say in these things that anybody who tells you that he or she is certain of what's going to happen in the next year is a charlatan. Number 2, the second theme is debt, both private and sovereign. We have just lived through very significant sovereign debt crises in parts of Europe. There is still a lot of concern about debt overhangs in the private sectors in a number of very important economies, both the non-financial and financial sectors, notably the US, also the UK, Spain, the Japanese public debt situation. So there's the debt problem broadly defined. How are we going to manage this debt problem, quote unquote? What happens as private debt is being transferred de facto increasingly onto the states? And does this mean more sovereign debt shocks and crises? The third theme is rebalancing. And I think here both rebalancing within economies and globally. Within economies, away from, in particular, some economies, very high consumption, very high dependence on expansions of credit to the household sector, towards investment, towards net exports, and also, of course, at some point away from this huge dependence on government deficits. And then at the global level, we associate rebalancing very much with the global balance of payments, the shift of deficit countries towards balance and surplus countries also towards balance. It's a very big theme of the G20. And the final theme might be described as coupling, decoupling, or uncoupling, namely the question of how far the emerging world is completely independent of conditions in the developed world, which are clearly very uncertain and rather grim at the moment, and even whether the possibility that the emerging world will actually be a driver for the advanced countries actually bringing about a global recovery rather than merely, quote unquote, a recovery in the emerging countries. So uncertainty, debt, rebalancing, and coupling or decoupling seem to me background themes for this discussion. And I can say this without showing my hand on what I believe about the future. I've probably written about that enough. So I'm going to start our discussion then with Mr. Ma Jiantang, and I'd like him to talk about how he sees the current state of the Chinese economy and the challenges it confronts over the next year from his perspective in exiting from its stimulus and in managing the legacy of the credit expansion, which was such a remarkable feature of China's response to the crisis. So, Mr. Ma Jiantang, please.
Chairman, do you want me to focus on Chinese market?
Sorry?
Do you want me to talk about Chinese market or talk about global economy?
I want you to talk about China in the first place, but if you wish to make a comment about the global economy, you're welcome to do so. But we are obviously particularly interested in what you have to say about where China is now and where it will go over the next year or so.
Oh, thank you. Thank you for clarification. From National Statistical Bureau, I have the responsibility to talk about China's economic situation first. As you may know, looking at China's economy in 2008, suffering from the severe financial crisis, starting from third quarter of 2008, China's economic growth rate was slowing down very rapidly. Price was decreasing, unemployment was increasing. In some of the companies, they stopped production and closed their doors. Chinese governments very rapidly put forward a package of stimulus policies to fight against this crisis. In about 1 year, Chinese government took the lead in achieve economic recovery. For this year, 2009, first quarter of 2009, and we are at the valley of this economic cycle. In first quarter of 2009, GDP growth rate was only 6.1%. Of course, this is not the final figure yet. In 2009, from January to February, industrial output increased only by 3.8%. After that, because of the fiscal policy, proactive fiscal policy and moderately loose monetary policy of the government, starting from the third quarter of 2009, Chinese economy began to recover. In second quarter, according to our rough estimate, we achieved 7.8% growth rate in the second quarter of 2009. The identified goal for that year was 8%, so very closer to that rate. In the third quarter of 2009, we are getting a growth rate of 9.1%. In the fourth quarter, if my memory serves me right, in 2009, fourth quarter, GDP growth rate was 10.9%. So coming to 2010, first quarter of 2010, economic growth rate reached 11.9%. After these figures are released, in 2009, in the latter half of 2008 and in the first half of 2009, people are worrying whether we can recover in a fast pace. In 2010, 11.9% growth rate was released to the public. Many friends are worrying about whether there are overheating signs in the economy. After that, Chinese government stick to proactive fiscal policy and moderately loose monetary policy. And the focus of macroeconomic control is to restructure the economy and also manage the inflation. We adopt many macroeconomic control measures familiar to all of you here, I think. GDP growth rate in second quarter 2009 come back from 11.9% in the first quarter to 10.3% in the second quarter. Industrial output, starting from the end of last year to the beginning of this year, it was a 20% growth rate. Now, it will come back to 13.5% in June, July, and August. Chinese economy in the first quarter leave people an impression of overheating. Well, in this process of recovery, people are worrying whether there will be second dip in the economy. From my professional judgment, I believe that the recovery of economic growth rate is from technical perspective, from the basis perspective. In first quarter and the second quarter of 2009, the growth rate was very low. So as compared to such a small base, in this first quarter and the second quarter of 2010, our growth rate was very high because the base was very low. Second, the recovery is due to the stimulus package of the government. It should be said that Chinese economy entering into the second quarter, Chinese economy is recovering and the structure is better attuned. And inflation is kept at a moderate level. From January to August, the CPI on average 2.8%. Although for August it reached 3.5%, on average it was only 2.8%. Around 3% inflation is appropriate, moderate inflation. So for this year, if we can maintain 10% growth rate for this year, and CPI is under 3%, I think this will be a very good result. And in a long period of time, China's economy will maintain stable, and we will focus on economic restructuring and the shift of economic growth mode and improve the quality of growth. If I have some concerns about the economy, I'm not worrying about the speed of the economic growth rate. I think China's economy will enjoy long-term stable growth. I hope that on one thing we can speed up, or have several concerns about one thing, that is when the economy is enjoying a stable and faster growth, how can we change economic growth mode in a more efficient way? How can we improve the resources allocation efficiency of the country? How can we protect the environment of this small planet? That's all for my presentation in this part. Thank you.
Thank you very much for the very thorough discussion of the truly extraordinary performance of the Chinese economy during the slowdown. And it is important to note that I remember back in Davos in early 2009 that there was substantial skepticism, and I was one of them, so I admit this, that the Chinese government could achieve such an extraordinarily rapid turnaround in the economy. So I think it is important to note that it is quite an extraordinary achievement, particularly in such a giant country and economy. So I'm going to turn to you, if I may, Mr. Sharbin. Perhaps you can take forward the remarks of your colleague and look forward to the future. He's described where we are and the challenges that the Chinese economy faces. And so how do you see the nature of the growth process, the restructuring of growth, which the Chinese government is committed to, working out over the next year, 2 or 3, and what effect will that have on both the aggregate performance and the nature of the Chinese economy we will look at?
Thank you for your question. Thank you for your question about the Chinese economy. Because now this meeting is here, so many foreigners sitting here are interested in Chinese economy. However, here we mostly want to talk about global economy.
Let's talk about the global economy. Let's start with China.
About China's economy, what has been said by Mr. Ma is very correct. Chinese government adopted the stimulus package, and the economy achieved a faster recovery. At the same time, we found out that China's economy in the past year, we see too fast credit expansion. That's why asset price are increasing, and we are seeing bubble in the asset price. And there are overcapacity in some industries. For these problems, I believe that Chinese governments are fully aware of these problems. As you may know, that Chinese problem is to solve the economic growth mode, and we have to change our economic growth mode and restructuring our economy. Domestic consumption has to be stimulated. However, it takes time and takes many efforts to be made in different fronts, in different systems. For example, Chinese government is making reforms of the income allocation systems. Under the backdrop of a global financial crisis, China's economic growth rate was still very high. Many scholars in China said that we should take note that from 2003 to 2008, we achieved a very fast growth rate. Such a fast growth rate may not be maintained. We should moderately adjust downwards our growth expectations. In this way, we can maintain a sustainable growth rate. Monetary policy should come back to the neutral position. In the next few years, double-digit growth rate for the economy will face a lot of pressures, face a lot of challenges. In terms of economic restructuring, we will start with consumption. We will look at medical insurance, pension, education. All of these things needs to be reformed. We have such a huge country with a large population within a shorter period of time. I believe that the effects may not be very obvious in the short term. You have to be aware of this. At the same time, we should further promote global economic growth. Another focus of economic restructuring in China is improve productivity and set up a new strategic industry for the country. For example, green economy, low carbon economy. These are buzzwords of the government and Chinese society. I'm happy to take note that Chinese government are taking faster steps in these areas.
In general terms, I'm looking from a global perspective rather than a purely Chinese one. Since the crisis, whenever we've looked at the prospects of the future, we have to remember that there's always a price to be paid during a crisis. We can't expect the same sort of high growth and added prosperity that we enjoyed from 2003 to 2007, and governments have to be clearly aware of this. So thank you very much for your attention.
Thank you very much for introducing us to the challenges ahead. We'll certainly come back to this. And now I'm going to turn to what I heard one, and no doubt more than one, Chinese official refer to as the other superpower. The US. So I'm going to ask Nariman Behravesh to comment on where he thinks the US is now and where he thinks it might go over the next year or two. What are the big issues and questions in his own mind about this so-called uncertainty?
Thank you, Martin. In our email exchanges, Martin asked me to focus on 3 questions, which I will. Will there be a double dip, or what's the risk of a double dip? What's the risk of a lost decade in the U.S.? And what might the midterm elections mean for the policy stance? Let me start off by saying that when Klaus Schwab and Warren Buffett both say there will be no double dip, who am I to disagree? And so, you know, I won't disagree. I will say that our own assessment is that both the risk of a double dip and of a lost decade are fairly modest, in the sense of no more than about 20, maybe 25%, just to kind of put some numbers out there. That said, I think the U.S. is probably headed for 2 or 3 quarters of fairly weak growth, 1.5 to 2%. And then in 2011, we would expect growth to gradually move up to about 3%. Now, this sort of hides a good deal of strength in the economy. If you dig down into the numbers, for example, the second quarter in the U.S. was only 1.6%. However, domestic demand was about 5%, just under 5%. The big difference was that net exports pulled growth down, GDP growth down substantially. Imports grew over 30%. Dig down even deeper, capital spending on equipment grew almost 25%. So there are areas of strength in the U.S. Exports grew 9%. This is all in the second quarter. So there are areas of strength in the U.S. economy that we shouldn't really forget as we sort of go through this. But I think it's important to look at the backdrop here. And a lot of research has been done recently. There's a very nice paper written by Vincent Reinhart and Carmen Reinhart on the aftermath of financial crises. There's, of course, the book by Ken Rogoff and Carmen Reinhart as well. And all of these studies show that after a financial crisis, you go through a period of very weak growth. And that's exactly what the U.S. is in right now. Deleveraging typically means slow growth. You know, some people refer to this as an epidemic of thrift, an epidemic of savings. And that's what American households and American businesses are doing right now. They're saving a lot. For example, the household saving rate in the U.S., around 6% now, up from 0 a few years ago, is the highest since the early 1990s. Corporate cash flow is as a ratio, as a percent of GDP, is almost at record levels. This is all good news, actually, in the long run. In the short run, of course, it means demand is an issue, consumer and business demand. But it is sort of ironic, you know, why are we unhappy that, say, American households are doing exactly what we all said they should do, which is save more? And that's what they're doing. So this is the dilemma we're in. It's a short-term, long-term problem. Long-term, this is very good news in terms of the sustainability of American expansion. Short-term, of course, it means there's this huge demand shortfall. Now, what happened, of course, we were lulled a little bit by special factors. The fiscal stimulus that the Obama administration put in place and the turn in the inventory cycle gave us a couple of quarters of very strong growth. So we sort of got lulled into thinking that was really what was going on, whereas in fact what's happened now is as these have worn off, we have gone back to this underlying growth of 1.5 to 2%, which is, again, typical in this post-crisis kind of situation. All right, but to answer Martin's question, what could trigger a double dip in the U.S.? And I'll focus on 5 quick factors here, all of which are possible, none of which is likely, I guess is the way I would say it. The first is that credit conditions would tighten again. Again, isn't happening right now. If anything, credit conditions in the U.S. are easing very gradually, But easing, we don't expect the Fed to hike rates until early 2012. It's a long way off. And it may do some quantitative easing, by the way. So factor number one, credit squeeze, unlikely. Number two, policy tightening other than, say, monetary policy, fiscal policy tightening in particular. Again, quite unlikely. I think our best bet is that after all the partisan politics is done, the so-called Bush tax cuts will be extended for at least a couple of years, so as not to create a de facto fiscal tightening in the United States. Number three, a sharp rise in the dollar. Again, unlikely. The dollar may rise relative to euro, but it's been falling and will probably continue to fall against most other currencies. So those three factors I don't think are very likely. The last two are a little more troublesome, get into this uncertainty that Martin was referring to. One is, what if consumers cut way back on housing, on autos, and so on? Again, that doesn't seem very likely. The pattern we seem to be in right now is consumer spending is growing at about 2%. You know, this is a 2% U.S. economy, if you want. And that's allowing consumers to save more. So they seem to have worked out this sort of happy medium. They're spending a little bit. It's growing modestly, but they're also saving. So in that sense, it's balance, rebalancing, whatever we want to call it. That is happening to some extent in the U.S. What about the corporate side? Well, the risk is they'll cut back on inventories, they'll cut back on capital spending, and they'll cut back on employment, which is, of course, the big worry about a double dip. But again, that doesn't seem very likely. You know, households, and I think, businesses, and Martin's made reference to this, I think, in the last panel, American businesses are sitting on a mountain of cash. They don't need to cut anymore. So the issue is, are they going to spend it? When are they going to spend it? That's the concern. And I think our view right now is they will start to spend. They're already spending massively on capital goods, especially equipment. They're beginning to spend gradually in terms of rehiring. Already, you're starting to see job vacancies rise. You're starting to see the employment numbers turn positive, albeit very slowly, in very small ways. But the good news is they are beginning to spend and to rehire. The hope is that that will accelerate in the coming quarters, and that will sort of bring about a more sustainable and somewhat higher growth rates in terms of employment and, of course, in terms of the economy. Now, as to the lost decade, just a few comments on that.
You're going to have to wrap it up fairly quickly.
Sure,
please.
I will, Martin. Lost decades are not ubiquitous. We talk about them a lot. There are only three that most economists would recognize. Of course, the Great Depression, the Latin America debt crisis, and Japan. In each of these, massive policy mistakes were made. I think we'd have to make that assumption to assume the U.S. was going to go into that. Let me just leave you with two thoughts here in terms of a lost decade, in terms of the U.S. And comparisons with Japan. Often the comparison is made with Japan. Two big differences with Japan. The first is the speed of the policy response. In the U.S., it was much faster and much bigger than anything Japan did. And secondly, and very important, this is my last thought, is corporate finances. Corporate finances in the U.S. are much stronger than they were in Japan in the 1990s. Just one statistic, the ratio of corporate debt to GDP in Japan in the early 1990s, 180%. Right now in the U.S., 90%, about half as much. So corporations are in much, much better shape now in the U.S. than they were in Japan's lost decade. Let me stop there.
Thank you very much. I think that's a very, very useful presentation of the issues. I'd just like to comment, because it's something that's often missed, this incredible building up of cash or financial surpluses of the private sector, which have helped them and are helping them, are of course the counterpart of the hated fiscal deficit, and which is why people like me have been saying for a long time, and obviously Nariman agrees, that these were a necessary condition for the recovery we're seeing, and people should really get relaxed about it. Okay, I'll now turn to Gerard, and I'd like you very much to focus on how you see the wider emerging market scene beyond China. And I know you've had some concerns about capital flows and how they're playing out. Emerging markets are now the flavor of the month or the year or maybe the decade. I sometimes wonder whether we're beginning to see the early stages of the next financial crisis. Gerard.
Thank you, Martin. Yep, maybe three quick points. First, the tale of two worlds. Second, levels. And third, coming on directly to Martin's last question about the challenges, particularly with capital flows. First, the tale of two worlds. I'm pretty bullish about the world economy. I wouldn't say it's a case of the glass being half full. My guess would be the glass is maybe 2/3 full. Unfortunately, over the next year and a half, maybe, we're probably going to focus on the part of the glass, the third of it, that's pretty empty. We have stagnation, in our view, in the States. We have recession in Southern Europe. And maybe we have a property bubble building in China. All of that needs to make us cautious about the near-term outlook. But despite that near-term caution, I think we should be fundamentally bullish about where the world economy can eventually go to. I don't think the world economy is decoupled. Emerging markets clearly are not decoupled from events in the West. We saw this in the crisis itself. The innocent suffered with the guilty. By that I mean emerging economies that didn't have leverage or debt were hit by the collapse in world trade. But the important thing is that the emerging economies were better insulated. Hence, they've been able to rebound. And growth rates in the near term look pretty good. Whereas we have stagnation in the States, our view is that we're seeing stabilization across much of Asia and in other parts of the world. As a result, I think we should actually sort of take a positive view about where the emerging economies will go to over the next 18 months and beyond. That's the first point. I can come back in more detail in the Q&A. Second, levels. Obviously, rates of growth are vitally important, but sometimes we overlook levels. What do I mean? Well, if we look at levels, the world economy is actually pretty much in a super cycle. It's going to have a big sort of shock in the middle of that cycle, as we've seen in the last 3 years. But a decade ago, the world economy was $31 trillion in size. On the eve of the financial crisis, it had risen to $61 trillion in size. 900 million people across the emerging world had been brought out of poverty. Unfortunately, maybe 100 million of those went back into poverty during the crisis, and the world economy shrank to about $58 trillion in size. Based on the IMF's forecasts, by next year, we'll be back to where we were, or slightly above where we were on the eve of the crisis. So we have had a crisis. We shouldn't underestimate the near-term challenges, particularly as debt and deleveraging impacts the West, particularly as that has some residual impact on the global economy. But what we're seeing is more of global growth is being driven by the emerging economies. The delta, the change, has been driven in recent years by the emerging economies. And on our forecast at Standard Chartered, by 2014, Asia alone would account for more of the change in global growth than the G7, the West. Not only is it levels in terms of GDP, trade levels are also important. Global trade was really hit hard in this crisis. Global trade, however, peaked in April 2008. It then fell 21%, hitting a bottom in May 2009. The latest data out for June of this year shows global trade has recovered to 98% of its pre-crisis level. And next month, on the next month's data, it probably will return to that. Global trade is not just trade between Asia and the West. 10 years ago, 80% of Asian exports went to the West. Now it's 2/3. Still important. But what we're seeing is intra-regional trade, greater trade within Asia, greater trade between Asia, Africa, Asia, Middle East, Asia, Latin America. Standard Chartered is heavily based here. Many of the multinationals we talk to in the States and the West, the ones with money, interestingly, they don't want to put their new investments in the West. They want to put their new investments in the emerging economies. So to conclude the second point, levels. The third is the challenges. At the Asian Development Bank meeting this year, which took place in sunny Uzbekistan, one of the interesting issues was about infrastructure investment. According to the Asian Development Bank, for Asia to basically realize its potential, and based on what Asian countries are saying themselves, about $8 trillion is needed over the next decade to achieve the infrastructure needs. China has that money. Many of the others don't have the money, and we need to see more of that money coming in. India has already started an infrastructure change, so too are other countries. We're seeing inflows, the other big challenge. There's many aspects to the inflows. There's the scale of the inflows. There's the change in the nature of the inflows. Equity inflows into emerging economies have held steady. All the big, best-performing currencies against the dollar this year are those where we've seen big bond inflows. 27% of Indonesian bond market now is held by foreigners. 24% of the Malaysian bond market by foreigners. Likewise, South Africa, big appreciation of the currency there. The big delta in flows has been bank lending. But I think the big story will not just be the foreign money that's coming into this region and to other emerging markets. It's the fact that, in my view, in the future, more of the savings will stay within the region. Now, that means that we need to see deeper and broader capital markets, quite frankly, across most of the emerging market space, but particularly here in Asia. That's happening, but maybe not happening quickly enough. So what's the next best step? Some currencies are being allowed to appreciate, particularly in Southeast Asia. Other countries, however, are still intervening. Asian currency reserves, for instance, went from 1/3 of global currency reserves a decade ago to now around 2/3 of global currency reserves. Up to now, they put the bulk of those in dollars, but now there's passive diversification. That is, they're not actively selling the dollar, they're putting less of their net new reserves into the dollar. And the biggest thing that's caused the stir amongst our clients in the last month was when the Chinese made a further change to their currency policy last month, unfortunately not allowing it to appreciate, but actually creating what's been called the CNH market in Hong Kong. Basically, by the back door, the Chinese are encouraging greater use of the CNY offshore, and that's a fundamental change which eventually will lead to the Chinese having to allow greater currency convertibility. So to put it all together, a tale of two worlds, levels, and basically the challenges, but the challenges are more ones of success for the emerging economies. Thank you.
Thank you very much. Just 2 points I pull out there, which I think are particularly interesting. The first is we have these very cash-rich developed country companies, and people like Nariman are suggesting they're going to invest. But Gerard implicitly or explicitly, is raising the question of where they will invest. And they could well end up investing much of this money in the emerging world, particularly in Asia. And the second aspect of this, we know that most emerging economies, or many, have followed a policy of essentially recycling these inflows into reserves. And after a very small dip, relatively modest dip of a few $100 billion in the worst of the crisis, the foreign currency reserves are rising again extremely rapidly, as Gerard has said. So we are very much back to the pre-crisis pattern in terms of these global flows. And that now allows me to turn to Paul to wrap it all up and tell us what this means for the global economy as a whole, and pick up any specific points. If you can sort of keep down to 3-4 minutes, then we can go to questions after perhaps just one follow-up question I have.
Great, thanks very much, Martin. So I'd just like to say a word about how we see the outlook and then touch on 3 issues. One is sort of the lessons. What have we learned about the global economy from this crisis? Secondly, what is driving growth now? That's been touched upon already. And then thirdly, global imbalances, coming back to one of Martin's favorite themes. So just in terms of the global outlook, I think it is very much a tale of 2 recoveries. We're expecting the global recovery to continue. We're penciling in about 4.5% growth this year. But in the developed world, we expect growth for a number of years to be quite muted. We're out of the crisis, we're out of the recession, but this crisis will cast a long shadow over the developed world for quite a long time. However, the recovery and the strength of growth in the emerging world, and particularly in China, but also include India there, is very, very encouraging. What about the lessons from the crisis? What have we learned about the global economy? There's 3 things I'd like to highlight. First one is that the situation that prevailed running up to the crisis was unsustainable, as many economists were pointing out in that period. Too much growth was being driven by household consumption in the US. Secondly, we learned through the crisis just how connected the world was. So the decoupling hypothesis went out the window rather quickly. For example, peak to trough decline in GDP growth was about 4% in the US, a little bit more than 5% in the euro area. But Japan, which seemed to be well away from the epicenter of the global crisis, experienced a peak to trough decline in GDP of about 8.5%. It got clobbered. And of course, many emerging markets got hit as demand collapsed around the world. But the third point which emerged, which sort of runs a little bit counter to that one, is that we also have observed that the emerging markets, and again, China and India, are really at the top of that list, can grow strongly, even though we're in a period of very weak developed world growth. So there's a little bit of sort of decoupling once you get past that initial shock. And that's really because the fundamentals in the emerging markets, of course, are very, very favorable to high levels of growth. But that has to be growth which is driven by domestic demand. The second point, moving on to the drivers of growth, and this has already been covered, so I'll be very brief, is that we are in a world in which global growth is being driven by the emerging markets, and again, particularly by China. On our calculation, and we use purchasing power parity rather than market exchange rates, but on a PPP basis, over the forecast horizon out to 2012, China is contributing about a little bit more than 1/3 of global growth. If you add in India, it gets up to about 45%. India alone is probably going to be contributing as much growth as Japan and Europe combined. And emerging markets together, probably about 3/4 of growth. Now, in some ways, this is not surprising. This really reflects a healthy process of convergence that is going on in the global economy. And it's not surprising that when you have rapidly growing economies, arithmetically over time, they become bigger shares of the global economy, and if they keep growing at a rapid rate, they contribute more and more to global growth. So, that's really what's happening. However, what that does mean, of course, is that these economies, China in particular, are increasingly important for the global economy. What happens in China in particular can have a big impact on the global economy. For example, were there to be a pullback in investment in China, that would have a pretty big impact on the rest of Asia, and I dare say would be felt around the global economy. These are no longer small countries. The world is hugely invested, if you like, in how these new economic champions perform, to borrow the title of this symposium. Third point, let me just wrap up by going back to global rebalancing. The good news is that it is happening. It's a rather precarious process, and there's a little bit of a mixed scorecard here, but the silver lining in the crisis is that a global rebalancing is happening. And again, China really goes up to the top of the table here. In 2008, the current account surplus in China was pushing 10%. That's now down to half of that level, and for this year, we're expecting, or next year, 2011, we'll be expecting that to be probably around about less than 2%, let's say, around about 2%. The US current account deficit peaked at about 6.5% of GDP back in 2006. That is now down to about 3.5% or low. Perhaps a little bit still too high, but moving in the right direction. Japan, on the other hand, a little bit left out of the global discussion. Actually, the current account surplus is above 4%, and we think it is rising. A lot of people focus on deflation in Japan. The flip side of the deflation story is domestic demand remains weak, and Japan continues to recycle a lot of savings to the rest of the world.
Paul?
So that's really the last point I wanted to make. Unfortunately, for global rebalancing, for progress to be made with global rebalancing, it took a major financial crisis and recession to get us started on that path.
I'm going to ask one question, actually, of Mr. Sharbin, and I don't know whether Mr. Ma wants to add anything, but because I think it's one that will interest a great many people. We've brought out very clearly the central role of China and the expectations of China. There's a lot of discussion outside and presumably also inside China about this theme of property bubbles, asset price bubbles, and the potential consequences of that for the Chinese economy. Is that something we should worry about at all, or is it an irrelevant issue?
This is a very important issue, and this is an issue of concern to foreigners and to Chinese people. As I said just now, that last year, because of the faster credit expansion, monetary supply, experts are aware that such faster credit expansion with a decreasing export, real investment space is narrowing. Under this backdrop, there will be two results. First, property bubble. Second, overcapacity in certain industries. Stock markets. Last year I said that stock markets in China, at the very beginning, Chinese people's are bite. The figures are bite. It means that the price lowering. So they are not willing to invest in stock markets anymore. So much of the money was channeled to industries, leading to overcapacity. After discussing all these points, we want to promote export. However, in first quarter, second quarter, third quarter, we are seeing declining growth rate in 2009 due to the basis issue and also due to macroeconomic adjustment issues, because we want to adjust the economic growth rate downwards. Three policy factors are very important. First is real estate sector policy. Second, policy related to overcapacitated industry with a high energy intensity. Government wants to reduce these industries with high energy intensity. Third, for local government financing platform, these policies has also been issued. After these three policies has been issued, many banks are not willing to offer loans. In this way, economic growth rate go down slightly. Looking at the real estate sector, I take note that many foreign media said that this will result in uncertainty in the economy and risk in the economy. I personally believe that China is still in the fast growth period. To solve this question, I used to work in People's Bank of China. At that time, we make reform of the trust company. About 100 trust company was closed, go bankruptcy, but the society is still very stable because we take a gradual approach. We take a long period of time to adjust the sector, trust sector. For retail sector, we will also adopt a gradual approach. The orientation, direction of the adjustment is that we will not learn from UK and US. We will learn from Germany. For real estate sector, the most important thing is to learn from Germany. To buy a home is for live, not for investment. If you buy a home, buy an apartment for investment purposes, you have to pay a lot of tax, pay a lot of money. That's the direction of government policy. To arrive at this goal, based on the current economic situation and the difficulties faced in economic restructuring process, we will spend 2 to 3 years in adjusting this sector.
I have to say that's very, very sensible. Can you be very, very brief, because I really want to go to questions, please. Do you want to say something now? We can, but be very brief, please.
I will be very brief. For China's real estate sector, the adjustment of this sector will have an impact on the economy. About the scale of the impact, two figures are very important. First, real estate investment accounted for 20% of total investments in the society. 20%. So it will only take 1/5 of the total investment of China. Although Chinese government make adjustment of real estate sector, from January to August, growth rate in real estate sector investment was as high as 37%. And real estate sector contributed only a small percentage of total GDP. Although real estate sector in China, in terms of sales, from January to August increased 8%. It's still growth rate, still positive growth, and the total contribution to GDP is not very large. So the adjustment of real estate sector will not have a huge impact on China's economic growth rate. There will be some impact, but the impact will be not very large. Thank you.
Okay, you've heard what is actually a remarkably strong consensus across the panel about the direction of the world economy and characteristics. I would describe it as modestly optimistic, much more so obviously about emerging economies. Unfortunately, my own very lengthy experience is that consensus of this sort are always wrong. But you at least know what to bet against if you're in a hedge fund. I'm going to take questions. I'll take 3 or 4 together. Be very brief. If you want to address a specific person, say so now. So is anybody, gentleman over there, could you stand up so that they will give you the mic, say who you are, and really be brief. I haven't managed time as well as I would have liked, but to try and catch up now.
Yes, Tom Ashby from the national newspaper in Abu Dhabi. Does the outlook that you've just described involve a decline in the quality of life in the developed economies?
Very good question. Okay, next question. Somebody else who wants to answer a question? Somebody here? Yes?
我是信阳财经的编辑。
I'm from Sina Finance. I have a question for Mr. Ma. Just now you mentioned that China is interested in making adjustment of economic growth mode and also paying attention to protecting the girls. You have many measures adopted for energy and emission control. Can you introduce such measures to us?
Okay, we'll come to that in a second. Gentleman right in the front here. Yes, please.
Athabutabara from Zimbabwe. One of the major problems we're having is that we're having national responses to a global challenge, the global economic crisis. What can be done to incentivize national leaders to behave like global leaders? You can't have a national president carry out a program that will solve a national problem. Our leaders are national leaders. Our solutions are national. We are having governments solving a global challenge. What can we do to ensure that a national leader can act in the global interest, even if it means it is working against the short-term interests of their country?
Okay, I'll take one final question. The lady over there, I think, yes, please.
I'm from Q6 website. My question also goes to Mr. Ma. In our discussion, we found out there are uncertainties in the global economic recovery, and China is in the process of adjust the economic structure. There will be some volatilities and uncertainties. For National Statistics Bureau, do you want to optimize the preciseness of your data so as to better reflect this volatility and uncertainty, to reflect the reality better? What kind of plan do you have in this regard?
Okay, I'm going to assign these questions, which were not assigned to people, in a very random way. I'm going to start with Nariman Behravesh. I think it's appropriate because of this particular focus of discussion in the US. But say, if you want to say something about Europe, you're welcome to do so. Are we watching a decline in the quality of life in developed countries?
I think the answer is no, and let me explain why. I think Japan's a perfect example of what you can get when you get a couple of decades of very, very sluggish growth. You go to Japan, and people aren't poor. Their quality of life hasn't deteriorated. It's not increasing. And this comes back to Gerard's point about levels rather than growth rates. It's not dramatically increasing, but most people are very prosperous, very comfortable. And I think that's the sort of stagnant quality of life, but nevertheless high quality of life, that I think the US is condemned to in some sense, and Europe is condemned to in some sense. But I think I wouldn't say declining, but I would say stagnant. That's the term.
A genteel stagnation.
Indeed.
Which is not necessarily such a disaster.
Exactly.
The second question, which is not for Mr. Ma, the other two questions are for Mr. Ma, is there any way we can do better in ensuring a global response to global problems instead of a national response to global problems? I would actually take the view we haven't done that badly in this crisis, but there is now actually real concern about how well governments are staying together. There's a lot of divergence on fiscal policy, climate change. I'm going to ask Gerard to comment on this. Sorry, Paul, just a random, and I know you thought about this.
Yeah, well, in terms of the global policy response, I agree with you, Martin. I think it's been incredibly good. I've called it the good, the bad, and the ugly in terms of the West. The good is that former UK Prime Minister Gordon Brown did a great job at the London summit. All global leaders did pull together. And the good thing was that global policymakers basically addressed the problem. They stopped the depression. They minimized the downside risks. They threw the kitchen sink at the problem. The bad in the West was that they did this from a position of weakness. Governments in the West should have had budget surpluses. Governments in the West should have, or central banks should have had higher interest rates. In the rest of the world, the emerging market world, the positions going into the crisis were much better, largely because in Asia, people had learnt the lessons of the Asian crisis a decade ago. The ugly is the consequences. I think, apart from one or two countries like Greece, I think many of the worries about debt, public sector debt in the West, are overblown. The best way to get debt down is by actually having growth. But we do have stagnation in the near term. That's the ugly part. In terms of whether we should have a global response, I think we have had a global response to the crisis, but now quite naturally, because different challenges have been seen across the world, policymakers are looking to domestic issues. In Asia, for instance, inflationary pressures are a greater concern than in the West. In the West, deflation is the greater concern. Hence, interest rates in the West will remain low for considerable periods of time. That will feed problems in the emerging world as capital and asset flows come into the emerging world. So you can't blame central banks for starting to focus more on domestic issues. I think where we have seen progress is on the international response to the banking crisis, and I think what we saw at the weekend might not have been ideal. Capital was not the cause of the crisis. Lack of risk management was. But having a global response to international financial issues is very important. And maybe finally, protectionism is always mentioned, but maybe I would say, coming back to Martin's original question about rebalancing, to get a balanced global economy, we need to see the West spending less, saving more. That will take time. We need to see Asia and other surplus countries, including Germany, doing the opposite, spending more. Again, that will take time. But we also need to see currencies adjust. And I would greatly encourage the Chinese and other surplus countries to allow their currencies to appreciate gradually. So in answer to the gentleman's question from Zimbabwe, I think we have had a national or international response so far, but it's maybe quite natural that we should expect things to diverge, and maybe that puts the emphasis very much on the G20 and South Korea. I think South Korea's G20 will be
Gerard,
good.
You're going to have to
Next
stop
year's
now.
G20 might be more confrontational.
Okay.
Thank you.
Mr. Sharbin, very briefly on global governance, Chinese perspective.
I want to answer this question. I want to add my points here. Recently, U.S. scholar read an article that the world is flat. Thomas Friedman said, I agree with him, that the world is flat. So I disagree with the U.S. guy about the declining quality of life. I believe that the life quality have to decline to solve the crisis. After a crisis, the quality of the life have to decline because balance sheets are in poor states. What is crisis? Crisis means that because of the credit expansion in U.S., because of the subprime crisis in U.S., that's why we have a crisis. So this crisis is caused by similar causes as compared to previous crisis. That is a credit expansion. In today's world, we are taking paper money. So the biggest lesson about global governance is related to money. Recently, Basel issued Basel III. The essence of Basel III is to reduce leverage ratio. Leverage ratio should be reduced. If you know Western economy and if you know Western economic theory, you know that monetary supply is because of base money multiplied by banks, money created by banks. So Basel II lower the leverage by non-central banks in creating money. However, if central banks print more money, it means that the crisis will happen again. It's a simple math. It's a simple math. Central bank equals 2, and commercial banks, companies represent 4. So 2 multiplied 4 is 8. If central bank equals to 4 and the commercial banks becomes 3, it means that it becomes 12. My conclusion is that for global governance, the most important thing is not about supervision or regulation. The most important thing is that we should control the base money. The major currencies need to be controlled.
Get into that issue. I don't agree, but we can't. We'll leave it. This is going to take us an hour or two to discuss the nature. I think the money multiplier model is completely and utterly irrelevant now. And it's a piece of intellectual archaeology. But we will get into this if you want.
Martin, could I just come back to the quality
if I don't stop this, they're going to shoot me. And Mr. Ma has been asked 2 important questions. So first, and I'll never be invited back. Just think how sad that would be. Emission control, you were asked about, and the quality of data. And then I'm going to have to wrap it up. I'm really sorry. Please, Mr. Ma.
Right. Well, I'd like to thank the 2 questioners for directing their questions to me. Firstly, during and beyond the 12th five-year plan, the main task for China is to realize a change in the development model with stable growth. Firstly, what we can do as a statistics bureau is provide an objective basis for all other ministries and companies to drive that development process forward. Secondly, we need to give an accurate picture of the transformation itself. Now, the key task for everyone in the statistics sphere is to give an accurate picture, never mind official Chinese statistics or other countries' statistics, of the twists and turns of the economy. But it's very hard to get every single person's sentiment, what happens to every single person, into that picture. I can't tell you what everyone in this room is feeling about prices. All we can do is generalize. Thank you.
And I'm sorry, we can't go more into emissions control and the environment. And unfortunately, we could obviously go on with the discussion, but I think you've got a very, very strong steer on the way things are going to go. We're going to have, everything's going to be wonderful in the emerging world. There are no problems in China that really are important from this point of view. And the developed world is slowly going to recover after a few not too great quarters. And as I said, I think it would have been interesting to have had another discussion, which we just don't have time for, on what could go very seriously wrong with this. But the one thing you can be quite certain is that there will be some big surprises of some kind, possibly associated with sovereign debt, possibly associated with bank debt, once they start realizing what these new capital rules mean, which are important and could lead to rather large changes in the behavior of the banking sector, possibly. So, expect the unexpected. It's banal, but it's true. Thank you very much to the panelists. I think they've been wonderful.